Hey investors, this is a monthly deep dive video into global financial markets, into the main drivers and indexes and indicators for global financial markets. The main point of these videos is to try to make retail investors aware of where their globally diversified funds, pensions, etc. May be heading. The whole point is to try to avoid the big downturns, the secular bear markets. So, for example, here we've got looking at the US 500, the SPY ETF, and it's to avoid, like this is the Great Financial Crisis 2008, to avoid these drops. This was the dot-com bust, to avoid these kind of big secular bear markets. And obviously, we've seen something similar in 2022, and we'll talk about that. So that's the whole point. You can head over to Boom Bust Invest .com/strategy, or go to the Boom Bust Invest menu and just go to strategy, and I'll talk a bit more about, I look at the moving averages that I look at and the different indicators, to sort of try to help avoid, or at least be aware of what's happening. So that's the whole point of these videos, and I'll be doing like a monthly, as I say, monthly videos. So you can sign up on the Boom Bust Invest homepage, and you'll get like a reminder that these videos for each particular month when they come out, or you can just come back to the YouTube channel and just sort of check there if you want. So yeah, that's pretty much why I'm doing this. There's no financial advice being given out. It's just, there's no recommendations being made or anything like that. It's just education and showing kind of what I'm doing. So I'm a DIY investor, so I might choose to take capital out and put it in at certain points. So I'm just explaining how I do that, and that's what Boom Bust Invest is pretty much all about. So let's just jump in then. So this Boom Bust Invest /crash homepage you can get to by coming Boom Bust Invest and just pressing on that main menu there, financial crash. Now, I called it crash not because I'm a perma bear or because I think the market's always about to crash. Quite the opposite. But like I say, we're just interested really in when there is a bear market, of when it's happening and when it's bottoming out, and it's as simple as that. So that's why it's called crash. I'm not a perma bear. I don't always think the world's about to end. So right at the top of the page, then there's just like a general chart here. You can have a look at sort of the short term, 1 year, and medium term. So this is on the SPY. You can click just to get a sort of quick picture. So this is the Nasdaq, the more tech focused index here, and you can get a sort of a picture of like sort of where we are now. So just very quickly, shift back here. So the S&P 500. So I'll talk about the S&P 500. It's the biggest stock market in the world. Lots of globally invested funds will have a larger allocation to it because they're weighted by the market caps of stocks in the index. So I will look at this, but I will also look at the sort of Europe, and I'll look at the UK. I'm in the UK, so I'll look at the FTSE 100, for example, and we'll look at other indicators as well, like the Korean Kospi index, which is a good sort of market indicator for the global demand, etc. So yeah, S&P 500 then, obviously we've seen that turn down since the start of the year, and it's made another recovery here. So that's kind of looking rather promising, but we'll talk a bit more about that. And then the Nasdaq is pretty much the same, the big US tech, biggest tech stock index market in the world as well. Again, staging recovery, so that's a good sign if the riskier tech stocks are making a comeback. The Dow Jones, or more of the sort of traditional industrial stocks, have made a better recovery. So again, another good indicator. Europe as well, so this is a German DAX. Same story across the board. Seeing pretty strong late year recoveries. So sort of seasonal rallies, I guess, Santa rallies, whatever you want to call it. and the UK FTSE 100 as well. So pretty much regained those highs. So it's a good sign. We're not seeing a continuation of the slides that we've seen during 2022. If you've been in the UK, you've done better than if you've been invested just in the SP 500. So, and again, this is the whole point of globally diversified funds, is to sort of smooth out those regional variations. So overall, snapshot, not bad, making good recoveries from the drops that we've seen. Things like commodities as well, we're seeing those come back. So gold's made some good late stage comebacks here when it looked like it might be falling further down. Oil is still on the way down, which is good for stocks. Gas just sort of ranging sideways, but again, it's maybe heading down. Again, this is all good bullish for our globally diversified funds, which is what we're interested in. Yeah, Skulls talked about that. So that's just a sort of general widget there that you can come back to and sort of look at and take a look at the various kind of major asset classes there. So the S&P 500 then, and again, this chart, if you come back to Boom Bust Invest Force that crash, you'll get the latest charts, so you can see exactly what the position is. So as we can see here, it's been a very late stage recovery here, and if we see this continue, you can actually add in moving average indicators here. So just type in moving, take the exponential moving average indicator here. So this is on the monthly. This is 9 monthly. So as you can see, it's just starting to turn up there. And when this 9 monthly chart, as you can see here, for 2000, when it turns down, it's not a good sign. You want to be kind of out here, and you want to be kind of in here when it's turned up here. So it took to about 2003 before it turned up. This is the kind of thing that I talk about in the strategy page here. Looking at these moving averages, like when they point down, it's a kind of a warning sign. So this is a great financial crisis. You want to be out there and in here. So it's a fairly decent indicator. And as we can see here, it's been very pronounced here. It's 2022, and we can just see it's starting to turn up here. So it depends. If we look at the daily, and switch it to the 200, which is, for example, what a lot of the big algo trading machines will trade on. If it goes above, so it has a sustained close above that 200 moving day average, then yeah, we could be looking at a kind of a melt up, which I think is quite possible to see kind of a sort of the trading machines coming back in here. The thing what moves the markets the most, and retail investors then coming back in and just having a melt up here as opposed to a melt down throughout December, maybe into January. And then my base case is possibly a downturn again next year, but we'll talk about that. So again, just looking at its moving average, we've broken above that big marker there, the 200-day moving average. And so if that continues and we break this previous sort of like major lower high, so we had start 2022, lower high, lower low, lower high, lower low, and already we've seen a kind of lower high there, but we've come back down, and if we break that lower high to make a higher high, then that's a good indicator that we have indeed turned a corner here in terms of the longer term trend. So we'll see. There's a lot of work to do for the markets to really confirm that. We could see come down and then confirm it, but it's got to break this previous high here. So it's got work to do. So we're not there yet, but it's heading in the right direction. So, breaking above that 200 moving day average was certainly a sign of strength and gives those algorithmic trading machines an excuse to bid it up here. So that's what we're looking for at the moment. That's what I think may happen. So that's just the US market. So again, looking at sort of trying to keep a wider perspective, global perspective here. The Korean Kospi is generally thought to be a good indicator of like where the global demand and global markets might be heading. So as we can see in 2021, sort of mid 2021 is when this market started saying there might be problems here, started heading down, and which was about 6 months ahead of when the wider stock markets started really coming down here. So it's a good, fairly decent sort of leading indicator. So currently then we've seen that trend again reverse, starting to reverse here. We'd need to clear this previous lowest high here in this trend down. So we did have a lower low here, but it's not as pronounced. It seems to be sort of bottoming. Maybe you could see it sort of inverse head and shoulders here and then up. So if we see that, that's a good sign that we've got some kind of reversal in our global markets. So we keep our eye on that one. Certainly at the moment is indicating that we might sort of be heading in that direction. So the global Dow, again, so not just US markets, it's 150 big blue chips from around the world by the Dow index provider, and this one is again showing signs of strength here. We've got a very strong buying interest here, breaking the previous lowest high. So a decent indication that if that continues, that would on a global basis we are heading back up. So yeah, that just adds to my base case of where we are at the moment. So I've got these indexes here from NSCI, from the index provider, global index provider, and so we just sort of take a look at these. So the real-time performance is a good one. So you can come back to these and take a look, but we'll just sort of like go over them quickly because the more sources that you base your analysis on, the more confident you can be that you're heading in the right direction. So this is kind of a nice overall picture of like all the various regions. We're more interested in the world region here, so we'll just look at that. And so the year to date is down 15%. Now don't forget that's coming from these artificially inflated markets after the COVID crisis, where everything's been sort of pumped up by the central banks. They got to the highs here, so it's coming down from very artificially inflated values here. So it's not for the US, it's come down more, but for our globally diversified funds, it's not quite as bad, but it is down 15% on that from that high. So yeah, we kind of need to see that coming down or going back up here on this. These start turning green. So that's that, and you've got different regions here. You can click into here. So I've just got some other links here on the page for the MSCI, so we can just sort of take a quick look at those. But again, you can come back and click into these if you want. So the country, you can, if you've got particular country funds, you can dig in here and see where they are: Japan, UK, etc. And then the regions here. So the world index is more what we're interested in, but there's the index minus the North America essentially. So we've got here. So this is the world index. Same kind of. So the MSCI is like the big index that a lot of the globally diversified funds are based on. So it's a good idea to keep on this. And again, we're approaching the previous lower high. So if we see that break above, again, that'd be a huge level to surpass. Again, giving more confidence that that markets are heading back up. I mean, this is all of the developed world stocks essentially. So, and then this one is actually minus the US. So the US is actually sort of dragging things back. You see, on a global basis, we have surpassed that lower lowest high there, and on the horizontal level there, and we're back above it. So again, this is an indicator that maybe the rest of the world is kind of providing more strength than the US markets at the moment. So yeah, that's the MSCI indicator. So I'll keep an eye on that to tell us like where we're heading. And then there's another one here, which is quite a nice little kind of like enthusiast. Some sort of investment enthusiasts has like put this up, and it's very nice. So again, it just shows each country here just heading back up here. So again, our globally diversified funds will pretty much have money invested in all of these countries and in companies in all of these countries. So if they're all heading back up, that's another good sign that each country is sort of showing strength. You can see it on a nice kind of visual graph there. So heading in the right direction. Again, different main asset classes here, gold and silver. We can see so the market's turned back from risk off now to risk on. So we can see gold and silver money heading back into those asset classes. Over the S&P 500, we've been looking at things like high yield corporates, the bonds and the treasury bonds here. Again, turning a corner here. So all of the asset classes, the riskier ones and the less riskier ones, we see prices coming back up here. So it seems to be light at the end of the tunnel there, which is a good sign. The banking system as well. This is if the banking system's unhealthy, then the whole economic outlook is going to be unhealthy. So just got a chart here for it's actually the euro banking system. So the likes or stock 600 European banks here, the top 600 banks. And once again, we've seen those come back up and show some strength, breaking sort of previous highs. Again, another good level that's been surpassed. Coming back down a little bit, but we'll see if that carries on. Then that bodes well. Again, so I'm looking at different areas here because all of our globally diversified funds we'll have some in Europe, we'll have some in the US, we'll have some in with Japan, and so I'm just looking at various indicators that are showing me strength, weaknesses, or health of various sectors, all to give us a clue where we're heading. So another good sort of indicator there that we're heading back up. And as I said, they high yield or junk bonds, so-called junk bonds, are a good leading indicator in general. So once again, this is just a chart where you can come back and see exactly what the current situation is with that. And as we see, risk on is back and money is coming back into junk bonds here, a good sign for the equity markets. Once again, this lowest low here, or the lowest higher low, so higher high, sorry, lower high, lower high, lower high, lower high. If we break that lowest lower high, then we're looking good. If we see this trend line, if you imagine the trend line there, I'm not going to draw it, but if you imagine that trend line, so we're right on it here. So we're approaching, same with the stock markets, we're approaching very, like with the 200-day moving average on the S&P 500, we're approaching some very tough levels here. So we could see, if we see this continue down in a sustained way, then we're heading back down again, more likely. If we see it come down and then go back up, then we're heading up. So we're at quite a sort of crucial point here. Current market valuation is another excellent resource here. So let's take a quick look at that. So this is brilliant actually. It's amazing what information is just out there for free. So this shows all of it is US based, but like I say, if the US goes down, then more than likely our globally diversified funds will go down again. So this just shows all of the sort of main valuation models. So you've got the yield curve, the Warren Buffett indicator, cyclically adjusted price to earnings ratio, CAPE. The main valuation models for stock markets. And the homepage, currentmarketvaluation.com, then gives sort of an aggregate of those main valuation models to show kind of where we probably are in terms of where if it's being overvalued, undervalued, or fairly valued. And when it says fairly valued, it's like kind of, there's a range there. So it's fairly valued, but on the pricey side, still fairly valued, but a better time to potentially buy. So this is a fairly decent indicator of like when is a good time to, or a good probability that when you're putting your money in the markets, you're putting your money in at a good time. So you kind of want it to be here as opposed to here, but still, I think if there's going to be money to be made over the next few months, then personally, I might be reallocating some capital, even though it's sort of getting into sort of the orange and red here. It's still, I think there's still a melt up in the offing here, but this is an excellent. So you can sort of take a look at this and see where we are at any point. Just go back to the Boom Bust Invest page and to get a link there if you don't want to write this down. So the yield curve model, though, the caveat to that is the yield curve model is one of the sort of best indicators going back here to like the 60s. So we'll take a look at this of like, when there is going to be a future downturn. So when the yield curve inverts, so this is the 3-month and the 10 year. So when the 3-month is above the 10 year, it's a good indication of a future recession. And so that's 2020. This is 2008 Great Financial Crisis. This was the dot-com bust. And before that, it hasn't. When it's not inverted, then we're kind of, we've just avoided. Well, I said 90s there was a kind of downturn then as well. So, but when this happens, then it's an indicator that we're heading for trouble. And so 2023, my base case is in 2023 we're likely to see a downturn. So this is basically being caused by the fallout from the COVID lockdowns, I believe. Yeah, so carrying on then. So again, the 10-year and the major market drivers are the major indicators that people look at are the 10-year, or analysts look at the 10-year and 2-year US government bonds, the huge bond markets. And once again, when we've seen these invert, so that's before COVID, that's before the Great Financial Crisis. So about a year or so later, we had the Great Financial Crisis, twice before 2000. So kind of warning signs here. When it went to the low point and came back up, that's when we see the recessions. It's likely, I think we've gone, this is actually slightly old, this one. This is from the Federal Reserve website. We've come below here and I think we're heading back up. So we're kind of like here and here. So the likelihood is we'll see some problems in 2023, possibly 2024. And again, you can check this Fred or Federal Reserve links here for the 2-year and 10-year, the big markers of where the equity markets are heading. So I should have these here. And so we can see this is over the longer basis, 2018. You can adjust the length here, so you can see for equity markets to continue going up, which is what we've seen, we need these bond yields to continue going down. So think of it as that's a simple explanation, but we need to see these continue down in order for our equity funds, globally diversified funds, even though this is just US, to continue going up again. So we want to watch this quite closely. So as we can see, this is good on the 10-year. We've heading down. This looks like a sort of longer term trend reversal here, but it's like a double top there. So that's good on the yearly. We see that trend there coming down, which is quite nice. And then on the 2-year, once again, so this is a 2-year. So we need to kind of see the same thing, but this the 10-year I think is the main one, but the 2 years also you can just about see it's coming down there. So if we go to the yearly, you can see how distorted it's been. If we go to the yearlies and we see that kind of a topping pattern here and then heading back down here. So we need to see that 2-year also sort of like coming down in order for the S&P. I mean, it's the S&P to go back up, but you know, the S&P is effectively a big part of most funds, so global funds. So we do need to see this continue to come down for those funds to keep going up in value. So you can check those out there. I've got the links here and here. And then the trading economics one. So that's inflation rate. So yeah, this gives another view. It gives a nice explanation here. So, you know, they're saying here that Treasury note rose above 3.6%. And then if you switch to the forecast tab, so you can see here the bonds coming down quite nicely. That's on the 10-year, and you can select the 2-year here as well. And again, you know, you can switch to the forecast tab here, which is quite nice. Take this with a pinch of salt. So if we go to the 10-year, for example, let's go back here. So you can forecast for the longer term. If we switch to the 10-year, I mean, this shows it going up. So and it's applying some kind of statistical method here, and showing that it actually, you know, according to that, it might be going up, but at the moment it's going down. So we'll see. But I mean, I think we can take this with a large pinch of salt. But you know, the risk is that you know what we're saying here is wrong, and we do see a continuation up, like in a kind of secular way, and it will go up like a little bit, I think, before it kind of flattens out. But in general, the story is that the central banks will raise it a little higher, keep them there probably for the duration of 2023, and then bring them down. That's the narrative. So, which will probably cause a recession. So you can keep your eye on that link there. So I've just got a link there for that if you want to keep your eye on that. Of course, the US dollar is vitally important as well. That's currently heading in the right direction, which is down. That's come down quite a long way. This is partly the reason why we're seeing our stock markets recover. So this is good. We need that to continue heading in the right direction. As long as that continues with the 10-year and 2-year yields, we should see our global funds continuing to rise. You can sort of stretch these out on the page as well. So you can see we've come from quite a long way down here. It's been artificially inflated and it's come down nicely. So as long as that continues, we're good. If we see it start to spike up again, then we're heading down again in all likelihood. So again, inflation on oil. So I've got UK and US inflation here. So I've just got the chart. So these are sort of live charts again. So if you come back, you should get the latest month. So the UK is kind of as usual with everything else. It just seems to be about 6 months behind the US. US peaking out around sort of June in 2022. We in the UK seem to be peaking out now. We'll see what happens in November. Maybe it's still high, but then the story is here that, you know, we should start seeing this, and that story should be played out around the world. You know, so for our global funds, this is good news. This inflation comes down, that's bullish for stocks. Our global fund valuations should start to go up again. So we need to see this happening in the UK and elsewhere. So we'll see what happens next month. Like I say, we're doing this monthly, but you can always come back to the page and check for yourself. So inflation heading in the right direction. But looking forward, the leading indicators of inflation, so the US University of Michigan 1-year inflation expectations is quite widely viewed, and so that's showing again inflation expectations coming down. They shot up for some reason in October, but come back down. So expectation. So on the longer term, so from April. So as we saw, this was like before inflation started to come down. So this is a fairly decent indicator, leading indicator of where inflation is heading. And again, the trend is down. So just confirming what we're seeing. And then the ProShares inflation expectation is another one that's widely watched. It's actually heading back up here, which is a bit going kind of against the grain. So we keep an eye on that. But longer term horizontal kind of resistance possibly coming in here, and then the trend lower high, probably a lower high here. As long as we see that come down, that's again, it's all of these indicators seem to be heading in the same, pointing to the same direction. So inflation coming down, good for stocks. And then the 5-year break-even rate is another one. As we've seen, that's come right down. This is I think quite a strong indicator. Inflation come down, but again, we've seen a little spike up recently, but trend is in the right direction. So this image just shows, I mean, this is going back to this again. This is from the Federal Reserve database, going back to, I mean, the recent spike in that 5-year break-even inflation rate was surpassed the previous high in like 2005, which was, again, it's like 2 years before the Great Financial Crisis. So really high here, so really distorted. So we are coming back down, which is good, but this is a kind of slightly ominous maybe. But yeah, so just to show how high it's been there, surpassed that previous high in 2005. So we'll see what happens. And then oil as well. So again, related to inflation, we want to see oil coming down. So the cost of business is lower. So this is good. This is bullish for stocks. So we're just seeing a continuation of that will be good. Kind of ranging a little bit, but it's come down from its previous peak. So it's sort of like a double top here. This is only 2022. So again, you can just drag these along to get a longer term picture. So go back to 2020 here, so it'll come up. And so along with inflation, then, this is a big component of inflation, should see this continue to go down, would be good. And then the fund flows as well, and we saw massive fund flows coming in after COVID, and all the central bank money printing just flooded into markets, pushed them all up. We saw in excess of 1 trillion go into global funds, which is bigger than the total flows of the last 20 years, just to show how much fiat money creation there was after COVID. So that's why we're seeing all this inflation as well. And so there's a link there, the ICI fund flows. So you can come and have a look at this, but this is actually fairly short term, but and it's US based, but we're seeing, so it gives like a description here, 23 billion for the last 6-day period. That sounds like a lot, but it's actually just 0.1% of the mutual fund assets, total assets. So, I mean, the important thing here is that, this is kind of a shorter term indicator of like, where is money flowing into funds, flowing out. So as we can see, there is a lot of fear in the market still. A lot of investors are sort of taking their money out, maybe. But again, certainly for retail investors might have to get this timing wrong, and take money out when stocks have come down and they're about to reverse, as we're seeing now. So this is maybe just sort of fear-based selling, but we are seeing selling. So if this continues, I might add this to, are we doing sort of weekly or interim videos, shorter videos as well, to show kind of what's happening on a shorter term basis. So this is maybe a bit of a warning sign that there's funds flowing out. So this domestic would be the US, and I think world here would just be, global stocks in mutual funds that are, domiciled in the US. But if anyone has any measure of like how actual fund flows, across the world, say for the MSCI, then please, add any comments or links that you think would be good to add to this. Very grateful. So, and then with bonds as well, see money flow out of bonds, 13 billion on the 26th of October, and then 6 billion on the 22nd. So it's a few weeks behind, but money's flowing out here. So we'll see if that continues. But again, that could be a little caveat to prices going back up. So let's see what happens there. And again, I think this is the final one we're going to look at, is like the market breadth. Jobs and unemployment. So, I do like various categories here. So these are just the main market drivers. I'll do another video for jobs and employment. So yeah, finally then, market breadth, a very good indicator. As we can see, sorry, it's a little bit hard to see this. If I just try and make this a bit bigger here, might be able to get a better idea. If we go back up to where it is, yeah, I'll redo this image, but what we can see here is the 200-day. This is actually the 200-day stocks above their 200-day moving average, and so this is 100%, this is 0%. And so the red markers here, when we've bounced off a kind of low point in that percentage of stocks in the index that are below their 200-day moving average. And each time that's happened, so this is COVID, went down practically to about 0 to about 2 or 3%, but that was an extreme. And see that coincided with the market bottom there as soon as it started going up. Back in 2019, we saw it go down to around about 10% and then come back up. There should be a red mark there, and we saw that was potentially a place where if you were using this indicator and you see it come back up, then you'd be getting back in. So this is a very long-term chart. This is going 2022 to 1988, so about 30 odd years. And once again, we see a low here. So it's harder to see here, but in a proper chart, you'd see these coming down a bit more and going back up. So this low here in 2016, kind of a double bottom there, but that was like around about 18% there. Back in, so if we go back to 2009, which is like the more pronounced. This is the ones that are kind of more relevant. So when this started going back up here in 2009, we started seeing the recovery from the great financial crisis all the way back up here. So it's the bounces of the lows below kind of 20%. Not always, I mean, this was just before 2009, so it's 2008. So this is part of that sort of general decline. We're really looking at sort of below, I guess, sort of below 15% really. If we're using this as a kind of mechanism to decide when might be a good time to get back into the stock market and when might be a good time to get out. It's more of when to sort of get back in, because the stock market generally is like growing. See, this is like 90%, so it's kind of close to that 80, 75, 89% for quite a lot of the time. So to use this time in the market, I mean, when it goes up well above 90%, it's kind of accurate, but not really. I mean, it's the lows that it tends to be a better indicator for. So, and as we see here, so the dot-com busts kind of bottoming out around 2003, and we see it go down to around about 3% there, and then when it chopped a bit, but I mean, going back to all the way back to 1990, when you see it come off those lows, we're dealing with probabilities here. So the probability is that if you are going to deploy capital into the markets again at this kind of point, yeah, you might see this come back down, but in general, going back to the 80s. You see it did it here. You might put your money back in here and see it come back down and come back. It's a sign that it's on its way back up, because it never stays. I mean, 2009 was the Great Financial Crisis was the worst kind of period for it stocks remaining kind of like in the doldrums here. Even then, once it gets going again, they take off. So if you're investing here, or at the middle of this malaise, here, every time, here, and we've just come down. This is actually quite old. We'll take a look now. We've come down to that level again. Chances are you'll see the market rise from there. That's a pretty decent indicator of bottoms. And as we can see, this is the 50-day stocks above this, and S&P 500, but stocks above the 50-day, and then stocks above. So that's at 90 at the moment, 2nd December. But again, coming off that low there, that's like 3, like a double bottom here, and the 200-day, so like the sort of stronger indicator of a bottom, I guess. So we saw that sort of double bottom there, coinciding with the stock market lows in June and in October, and we're back up to 62. So if we were looking at this on that chart above, the longer term chart, going back 40 odd years, it'd be down here. We've come down here and we're doing this, and we're back up here. So that's the kind of the overall. Then we're likely to see, I think, a melt up. So people getting back in, investors, institutions getting back in, bidding up the markets, and then we'll wait and see kind of what happens next year with regards to the longer term outlook, with these yield curve inversions indicating a recession. The jobs and employment situation is the one. So there's a separate video on this, but if this starts going down next year, then that's when we could see the stock markets effectively repeat what it did in 2022 and just start another leg down. So it's kind of like more what we saw during the Great Depression, where we did see the markets kind of going up during that and then coming down a long way and then going up and coming down a long way. Seem to be kind of heading into that pattern, ominously. But for now, I've personally got enough confidence to deploy some money back into the equity markets to ride up a little bit of what we're seeing in the shorter term. So thanks for listening. Please like and subscribe if you like this video, and if you got something from it, just to help the channel to grow. And I'll see you in the next video. Thanks for watching.